Good morning to our clients in the US, and good afternoon, good evening to clients in Europe, Middle East, Asia, and beyond. Thank you for joining our webinar with Rob Kaplan to explore the Fed, the economy, and bank stress. I think pretty much everybody on this call will know who Rob Kaplan is, so I won't spend too much time going through his biography. Rob was, of course, the President and Chief Executive Officer of the Federal Reserve Bank of Dallas, and as so, a participant and member of the FOMC. Rob has an illustrious prior career in the financial sector and is currently involved heading a venture philanthropy organization doing exciting work with social entrepreneurship. So we'll follow a format here where I will ask Rob a series of questions to walk through his views on current issues and developments, but we'll look forward to taking client questions. So please submit those via the Q&A tab on the webinar function box. Please don't email questions for live consideration because we won't be able to respond to you in real time, but we will of course get back to you as soon as we can. So with that, Rob, thanks again for joining us today. It's hugely appreciated.
Great to be with you.
Lots to discuss. Let's start by just setting the scene in terms of where we were on the eve of the eruption of bank stress in March. What is your sense of where we are, where we were in terms of the business cycle, in terms of real activity and inflation heading into this shock?
So as you and I have talked before, if you had to give a narrative, 2021 was we ran at 120 miles an hour in fiscal, monetary policy. Nominal GDP growth was 12%, so off the charts high. We slowed down to about 9% nominal growth in 2022, but then the Fed got in the middle of the action and began to hit the brakes. And so before this bank event happened, the Fed was in the process, along the lines you and I have talked about before, getting to plus or minus 5%, slowly draining the balance sheet with the intention of probably trying to slow nominal GDP growth down to something like 4%. You might have still had 0 or 1% real growth and 3 or 4% inflation, but you can't even talk about getting inflation to 2%, in my opinion, and I guess you get nominal growth down to 4%, and we've got a lot of slowing to go. That's where we were. Now, to your second point, so then most banks I talk to and bankers around the country are very careful about matching duration. In other words, so taking duration in their investment account, they're very careful about it because they understand the danger of a mismatch when rates are going up. They've also, most banks I talk to, got a flood of deposits coming in. And one study I saw, you may have seen also, that showed of the 5 trillion increase in the Fed balance sheet from 4 to 9, maybe half of that wound up in bank deposits and then investment accounts. So they've had to deal with a flood of liquidity. Unfortunately, what we found then up to the bank crisis, there are I'd still say a handful, but some number of banks who took duration risk. This is before we even talk about credit risk, which is coming. And if you then mark, which is what's going on right now, the stock market is going to page 165 of these SEC reports, looking at the hold to maturity count, marking to market. What's happened is there's been a dramatic re-rating of market value of net worth for banks across the country. They have dramatically less capital on a market value basis than they thought to have had 6 weeks ago. And depositors then, which we'll talk about in a moment, have either run for the door or insisted on an insured cash sweep. But at a minimum, they've also re-rated and said to the bank, I want to get paid a higher rate to keep this deposit here. So banks have lost deposits, and deposits they've kept are more expensive now than they were just 4 or 6 weeks ago.
So, Rob, the interest rate risk piece, in a sense, was hiding in plain sight, right? So, how do you think about the sort of the genesis and nature of this bank stress? Obviously, Silicon Valley Bank was the trigger for it, but why have we seen this stress propagate broadly enough that the authorities had to trigger systemic risk exemptions? What is your analysis of the shock here that we're dealing with?
So what happened, and I just so you know, I once this all broke, you know, watching March Madness on the couch, I looked at the top 40 banks in the United States, and if that sounds kind of laughable, it's that easy if all you're looking at is an asset liability mismatch. And I basically went through every hold to maturity account on the top 40 banks. By the way, Silicon Valley Bank was number 16. It is an extremely large bank. You could probably take the market cap and the total assets of all the banks in the state of Texas and add them up, and you might get to the size of Silicon Valley Bank. It's a big bank, so it was worth focusing on. What happened here is that bank, and there I've noticed of the top 40, there are a certain number of others, and I hate to mention names, that either had so much in a mismatch. Silicon Valley Bank, and I hate to say First Republic, are the two that come to mind, where they literally, the market value of their net worth before credit issues appear to me to be zero. You have a number of other banks who took maturity, had a mismatch, but maybe it means the market value of their net worth is 5 or 6%, not the 10% that's in their balance sheet. So it's not a viability issue. It's they need to raise capital issue, or something's got to change. But what happened from a depositor point of view is people got to remember, every company in the country who has, say, more than 50 employees has a payroll account somewhere, probably their local bank. It's almost always over $500,000, let's say. And they all woke up and said, oh my God, they're not going to take the time to do a detailed scrubbing of their local bank. Many of them just ran for the door if they could. And you must have got a lot of these phone calls. I know I did. Some of them were stopped at the door by an insured cash sweep proposal, which only cost 15 basis points, and that fixed it. And so obviously the Fed coming out with these new facilities and agreeing to lend 100 cents on the dollar against treasury or mortgage-backed securities that are worth 75 or 80, that has created, I hate to say this term, but it kind of put these banks on a ventilator. But you really don't want to be on a ventilator for the rest of your life. But that kind of settled things down. But I can tell you now, so this is quote unquote stabilized, but you have, I forget the latest access numbers at the Fed, maybe we're up to $350, $400 billion. Got to remember, probably 20% of that 400 billion is senior unsecured. I mean, in other words, the collateral is not worth enough to cover the loan. What's going on is most banks I know are now catching their breath. They haven't gotten a lot of sleep, but here's what they're doing now. This is phase 2 of this crisis going on right now. Every bank CEO I talk to, big and small, but particularly, there are 4,500 banks, just for your audience, just to put this in context. There's 6 GSIBs. We don't need to go who they are. There's another 5 or 6 systemically important banks. And then there's 4,500 others. 600 of those 4,500 are in the state of Texas. Every one of those 4,500 is saying, boy, I'd love to raise some capital, but my stock's down. I certainly don't want to raise capital now. Or worse, their market cap's down enough. They really don't even have enough market cap to raise enough capital. They don't want to merge. Their stock's probably down 30 or 35% from 5 years ago. So there's one thing left to do. And they're all shrink, scrub the loan book, shrink the loan book. Now, some people listening to this may say, well, why do they need to do that? I thought this crisis had calmed down. Here's the problem. They are very aware that their small, mid-sized bank has got exposure to CRE loans, real estate loans, as well as C&I loans. And by the way, their C&I loans are different than B of A or JP Morgan. These are really, they've got some risk in them, okay? And what they're worried about is we're now entering into the phase where CRE, a lot of CRE in this country is in workout mode. You'd like to hope the banks are properly reserved, but they may not be. And what they're worried about is there's going to be some stories 3, 4, or 5 months from now about these credit losses. They're going to create another spooking of depositors, particularly those with payroll accounts who stayed. And they're a little worried that maybe there'll be another deposit run 6 months from now as we head into a slower economy and more credit issues. So again, what's going on nationwide is every one of these banks has either frozen their loan to deposit ratio or more likely is very intent on shrinking it. And there's only one way to do that: scrub the loan book. And that's why a lot of small, mid-sized businesses in this country are getting a phone call saying, politely, at the end of the year, we're not going to be able to give you a loan anymore, or we're going to reprice your loan. And that new project we were talking about, either we don't want to do it anymore, or here's the new pricing, and the company is saying no. Now, a lot of people are trying to equate this stress to a Fed funds increase. And my reaction is, this is a binary stress. If you're a big company, your funding options, I don't think, have been damaged through this. And that's the fortune. By the way, that's the S&P 500 by and large. They don't borrow a lot from small, mid-sized banks. If you're a small, mid-sized company in this country, which there are hundreds and hundreds of thousands of them, this is like the Fed funds rate. I try to explain it. Might as well have gone from 5 to 10. It's binary. Your access is being affected, and it's affecting small, mid-sized businesses because the banks are trying to survive.
So, Rob, I think that what you're saying there is very interesting, because I think there's a general perception in many quarters that because we've seen some of the indicators of extreme bank stress, like the utilization of the Fed's emergency liquidity facilities, come off the peak, because we've seen some reduction in the deposit flight from the smaller banks to the bigger banks, that perhaps this thing is fading out more quickly and with less enduring damage than looked plausible a few weeks ago. If I hear you right, what you're saying is that's not correct, that yes, the heart attack phase perhaps is under control, but this thing has got a long way to run and is likely to be a major macroeconomic event. Is that fair?
Yes, it is. This is in the second or third inning, not the seventh inning. And the inning we're in right now is basically small, mid-sized credit in the United States. I don't know what the right word is frozen. And I guess to your point, using the health analogy, the patient is stable, but there's a slow bleed, and that slow bleed can't go on indefinitely. So I think this is a very serious situation. Now, what I don't understand, and this is where I think economists and people around the country should be thinking about, if small, mid-sized credit in this country is basically frozen or access is an issue, what's the ripple effects on the entire country? And I've seen some people on television, and I've talked to a few who said, oh, come on, Rob, we're in the digital age, and these small companies can get a loan online. And I had to explain to them, it doesn't work that way. Consumer loan is based on FICO score, but you don't lend to a local restaurant or retailer. You got to have a local presence in a relationship, and it's not an economic loan for a big bank. And so the thing I'm trying to figure out myself is, what is the impact on the rest of the country when these businesses are basically, the lifeline is shut off? These small businesses are the customers of many big businesses, and gets better. The other thing I don't get, everybody assumes this is a demand shock. I'm not so sure it won't turn out to be, to some extent, also a supply shock. In other words, if you have fewer options to get a product or service, because the small bit means big businesses will do fine, but it means big businesses will also have a lot more pricing power. And it'll be interesting to see how they use it. But there may be fewer choices, which may actually, ironically, on services, which is the sector on inflation I'm most worried about, you may have fewer service options. And so I don't know how all this shakes out. It's a big I don't know. How's that for an insightful comment? And I think it's better to admit that.
Absolutely. And one thing, just before I move on to the macroeconomics, in terms of understanding the sort of the banking stress itself, a couple of things. First of all, I was struck by your point that there could be another shoe to drop in effect as the issues around credit risk then rise to the surface. Because to date, it has been more about the interest rate risk, mark-to-market losses. But of course, the CRE issue is one that's now, very much front and center in the discussion about where things might go. So can I just probe you a little further around CRE? How concerned are you about CRE in general and the possibility that this could not simply continue to perpetuate a sort of chronic weakness of bank credit supply, but actually lead to new flare-ups in terms of concerns about specific institutions or clusters of institutions?
So just to put it in context for the listeners, these are rough numbers. Let's say there's $2.75 trillion of CRE loans from the banks in this country. And let's say there's another $2.75 trillion of C&I loans, commercial industrial loans from the banks. So then the question is, what percentage of those loans are held by big banks? And which percentage of those loans are held by those other 4,500? And it turns out CRE is a good example. Big banks don't have a big CRE exposure. It's mostly in those 4,500 banks. C&I is the same thing. I think I looked at this. The average yield on a JP Morgan C&I loan, for example, and I'm bastardizing these comments, is 200 or 300 basis points higher than the average rate on a C&I loan from one of these small mid-sized banks. Why is that? These are very different businesses. The character is dramatically different. So what's the point? What I don't know, and what we're going to find out the hard way, is are these banks properly reserved for these workouts going on right now? And the CRA industry is every developer, they're in workout mode. Now, when I say workout, they're restructuring loans, and they're realizing that the project doesn't work anymore with rates this high. And so they're losing equity, but they're trying to restructure the loan and survive. I just don't know how much of this has been properly reserved for in the banks and how much isn't. But I think this is a lot tougher to see. The asset liability mismatch you can see from a mile away. The credit issues we're going to have to let unfold. And my guess is, talking to bankers, you're going to see some percentage of it isn't properly reserved for, and will show up then in bank losses, bank earnings. And that may scare people, i.e. the depositors.
And, when we talk about the set of financial stability policy instruments that have been used or remain available to the authorities, my sense is that the instruments that have been left in place or revised after Dodd-Frank are still pretty effective at containing turmoil, but may not be particularly well suited to supporting the consolidation and restructuring of the industry. I'm thinking, for instance, that open bank assistance is no longer permitted. So in order for there to be any element of FDIC support for a rescue takeover, that entity needs to first be seized by the regulators. Do you think we have the right set of tools? I mean, in the S&L crisis, ultimately, we had to create new vehicles, right, to help sort of bring this together. How do you think about the set of policy tools and levers there to work at this new emerging phase?
So let me answer this in two ways. And one of the, as I hate to do, is backward looking. If I go back 6 months ago, or 9 months ago, better yet, we actually had lots of options. And you would have liked to have thought in those cases with the big banks, you had these asset liability mismatch, that we went in and policed it right then. And it would have been not that expensive to fix the problem. So I really feel bad and regret. I don't understand why it didn't happen, and I regret it didn't happen. Okay, roll forward today. There are choices now. I think the tools, the issue isn't with the tools, I'm afraid. The issue is now with a trade-off. And what I worry about is as we go into this downturn, which I assume we're going into, you need small, mid-sized banks to have some muscle to lend to small, mid-sized businesses to motor out of this coming downturn. And I don't see that we're going to have it. Okay. And that's my worry. So I have a solution, but I can't believe I'm proposing it now. I would have, if you told me 9 months ago, I'd be proposing this, that they take me out and shoot me. I must have lost my mind. I actually think that at the Treasury and FDIC, and then they'd have to go to Congress, I wouldn't insure all deposits on the one hand, but I would be looking hard at options for potentially, say, insuring all checking/commercial payroll accounts up to $2 million or $3 million. Now, the reaction would be terrible to that proposal, but I think that's the only idea I've been able to think of that would stabilize this small, mid-sized bank situation. Doesn't take away the fact they're going to have credit issues. You're still going to have failures. You're still going to have undercapitalization issues. You're going to still need to merge a number of them. But I worry without some action, we're just not going to have muscle coming out of this at the small, mid-sized bank level. And for those who think we don't need small, mid-sized banks, come live in Texas for a year and travel around the state with me. Then tell me you still think that. I don't think you'll still think that.
So let's just move on a little bit to the macroeconomics of this, which you've already begun to talk about, Rob. So I completely appreciate the important point you made here, which is when we talk about rate equivalent tightening, it's important to understand that this is a very different type of tightening. Its incidence is highly asymmetric. It doesn't work like interest rate increases.
Right.
Nonetheless, there is a basic difference between those whose working hypothesis is that this is a material development, but of moderate scale.
Right.
Chair Powell suggested like a 25 basis point or a bit more of rate tightening in the March press conference.
Right.
And those who would be inclined to see this as a much bigger macroeconomic shock, I would note that the Fed staff themselves at that very same meeting seemed to take the view that this was a much bigger shock. And as we reverse engineer their forecast changes, it seems that they were treating it as if it were like 100 to 150 basis point rate shock. So separate from the precision of these things, there's clearly a pretty big difference of view as to whether this is a moderate thing that's important to take into account at the margin versus this is a big thing that is likely to have profound implications for your forecast and the path of the economy. I think I know which camp you're in, but just tell me in your own words.
So my guess is, well, the short answer is I don't know, which there are times in life where I think the smartest and most insightful thing I can say is I don't know. But my instinct is, based on all the work I'm doing, I'm closer to where the Fed staff is. So this gets down then to the culture, methodology. You lived at the Fed for a long time. I was there for 6+ years. There's a tendency to want to equate everything to linear basis points. It doesn't fit this situation. And there's a tendency to not react to something unless you see it in the quote unquote data. Yeah. And the problem with that is, my guess is what's going on right now that I'm seeing on the ground, it'll take 3 to 6 months for this to show up in the data. I am confident when that happens, you'll hear people at the Fed say, oh my God, we've got a much more significant situation and it's apparent, but they're going to say it with a lag, is my fear. And so then you get to, what is the job of a Fed president? What is the job of the FOMC? And I feel this strongly myself. My job is as a risk manager running the Dallas Fed. I don't know exactly Here's what I think. My guess is we're going to see some very severe impacts in 3 to 6 months in the data. But I realize if I wait that long, it's too late. And my own judgment from a risk management point of view, and again, I come from a business background, is I would actually not raise rates in this meeting. I would say, though, I wouldn't have raised rates in March either, by the way. And I said that publicly. But I'd say the following. The war on inflation is alive and well, and you should be prepared. We're going to raise rates in the future and do what we need to do. But we're going to turn over a couple of more cards on this banking situation to make sure we understand the impacts of it. And the truth is, from a helping fight inflation point of view, going from 4 3/4 to 5 to 5, 5 1/4, 5 1/2. What's the difference? I don't know. But from the banking crisis situation, I can tell you very soon, you just tighten the tourniquet and the funding costs on these 4,500 banks. By the way, don't worry about the effect on the top 500 companies in the United States. If anything, ironically, if the Fed raises rates once or twice, I would guess their funding costs may go down because they tend to fund based on the 10-year treasury. And my guess is the curve will just get more inverted because people think it's more likely we're going to have a severe downturn. From a risk management point of view, my judgment is this is going to show up in the data 3 to 6 months from now. And my own view is, from a risk management point, if we were at 2% rates, then I'd say, I don't care, we got to move. But we're already at 4 3/4 plus or minus. I would not act in this meeting. My thinking is purely risk management. Do I know all the answers? Am I sure I'm right? Of course not. But it's pretty, from a risk management point of view, I'm pretty convicted, in other words, confident I would not raise rates in this meeting.
So separate from the question of raising rates.
And by the way, I'll mention one other thing. And I would do one other thing, which I would do behind the scenes. If I were still in my job at the Dallas Fed, I'm even doing it as a citizen, I would be actively promoting the idea and requesting that we do analysis on the impact of some type of enhancement to insurance for these payroll accounts, business checking accounts. And I'd be furiously doing work behind the scenes, not talking about it publicly. If that got addressed, then I think then my risk management calculation would change. And I would have a lot more latitude. Without something happening like that, I'm afraid we've got something coming that we don't fully understand.
If we were to move forward in time and we were to start to see that evidence of credit tightening really showing up 3 to 6 months forward in the macro data, if you were in your old seat, how would you think about the reaction function around rate cuts? So inflation, of course, still running at a very elevated level, including on a core basis. Would you take the view that we need to sit tight until inflation is at least, let's say, on a core basis down in the low 3s or below 3 or some other threshold? Or would you actually be willing to go so far as to say, I'm seeing enough in the credit data and the early impact of that on the macro data to be willing to cut rates?
All right. And so in my seat at the Dallas Fed, and I haven't worn off thinking that way still, I don't want to cut rates this year. I don't want to get ourselves in a position where we need to cut rates this year. I want to communicate to people, be prepared. Rates are going to stay at this level, and for an extended period of time, get used to it. The one scenario where we would have to cut rates if we overraise now, I think that would be very damaging to have to cut. You talk about the war on inflation. See, but my view is the war on inflation would be a lot tougher to solve, because I think there are 50 million workers in this country that make 50 grand a year or less. They can't make ends meet. In other words, the wage price spiral pressures at that level are intense. We've got an energy transition plan in the United States. Forget what side of the aisle you're on, but we're limiting fossil fuel production. We're very vulnerable to price spikes over the next year or two, in my opinion, as we make this transition. Who gets hurt worse by those? The people making $50,000 a year or less, who can't make ends meet, who need to drive to work. And so my concern is that I don't want to raise. If I raise to high enough where I think the risk of having to cut is high, I don't want to do that. I want to be consistent and stable. I'd far rather stay at where we are now, 4 3/4 to 5 all year, than raise to 5.5 and have to cut to 4. That would be, you talk about confusing people. This is not a 6-month battle. This is going to more likely be, in my opinion, a 2 to 3 year battle. And if you have that mindset, the second you start cutting rates, you've confused the heck out of people. And so that's a big part of my thinking.
I fear that what you are concerned about may indeed be what materializes. In other words, the committee has a degree of inertia around rate increases, wants to do at least one more on top of the hike you said you may not have done back in March. And this could easily, in the context of the credit shock, generate conditions in which they do end up having to reverse and cut this year, despite having made strong statements to the contrary up to this point.
So I agree with everything you said on fear. And again, the big prism I'm looking at, this is a 2 to 3 year war, maybe longer. It ain't a 6-month war.
Are you talking here the war on inflation or the war
you bet.
on
the war on inflation? Yeah. We now have a big impediment in the middle of that war. That's why I'd like to make structural changes, do what needs to be done, get banks so they at least can function. Still going to be a lot of failures and everything else, but yes, risk management.
So Rob, you don't share the view of the Fed staff that the credit shock will not simply be large, but also powerfully disinflationary, which was the other aspect of what we learned from the minutes yesterday.
So it's not, that part isn't. Now listen, the textbooks would say and the models would say, of course it's disinflationary, but I see increasingly supply effects also. Okay. And so
there's actually quite a lot of literature on that as well. And we've done some work which, finds that, at least in some prior episodes.
So, but listen, I was 10 years in academia. I was 6+ years at the Fed. I don't have to agree with everything their analysis says. I think they've done a lot of good work. And I'd say I agree with this part, but I question that part. Perfect. You have a debate. So that does not undermine the quality of what they're warning about. But I don't agree with that last part. Let's put it this way. They may turn out to be right, but it's not obvious to me.
So I want to move in a moment to our client questions. So just again, to encourage clients to post the questions on the Q&A function on the webinar. While we collect the final set there, Tobin, was there an issue, for instance, around regulatory or other reforms or long-term implications of this crisis that you wanted to discuss with Rob first?
Yeah, absolutely. I mean, you mentioned the need for some action on deposit insurance. I'd love to get your sort of brief take on the broader regulatory response, and I think in particular, given the extent to which you're focused on the macroeconomic implications of small and mid-sized banks being unable to extend credit to CNI and CRE. How do you think about the kind of tension between timeline and strictness in terms of re-regulation versus the viability of the kind of mid-sized banking sector and sort of exacerbating credit shocks there?
So let me put this in kind of, when the limit on stress testing got raised to whatever it was, from 100 to 250, something like that, I strongly disagreed with it. Okay. But I didn't have a vote in it. That was the Board of Governors vote. Fine. So be it. Having said all that, what I just said, what you just saw at Silicon Valley Bank and this duration problem, I hate to break it to everybody, it ain't a lack of regulation issue. This is I think it may be a cultural, I say this constructively because I've made many mistakes in my life, a cultural training mindset, maybe even mix of people who are in your around the table or in your supervision area. Again, you don't need to be inside a bank to have observed an asset liability mismatch. I can sit on my couch once I get the SEC report and see it. I think maybe that's the first postmortem. In other words, by the way, I hate to say this too. I didn't have input into the stress tests every year. Bank presidents don't. I asked to have it, but I didn't. I understand that the most recent stress test of the big banks did not have an interest rate spike scenario. Now, again, I'm reading this in the newspaper, and I can't believe sometimes what I read in the paper isn't always true. I can't believe that could be true. But my point is, our go-to is always, let's just toughen regulation. That'll solve it. I think human beings play a role in this too, all of us. And I think leadership, again, if Silicon Valley Bank was the number 1,500 bank in the country, I'd say, well, I could kind of understand why it didn't come to the attention. It's the 16th largest bank in the United States. When I first got to the Dallas Fed, the first thing I said to the team is, I don't need to understand all 600 banks, but I need to understand in detail the top 25. So, you segment it, fair enough. But this was the 16th largest bank, and I read the public comments, I won't get into this, on how it just came to the attention of people at the Board of Governors in February. They said, that's not a regulatory issue. That's a something other, that's a different kind of issue. And I think the Fed would do the country a favor to figure out whether this was a leadership, culture, training issue, because without getting to the bottom of that, the tendency of Congress is going to be, listen, I've got to make sure that doesn't happen again. We just need more regulation. I don't know that this was a regulatory issue, even though I do not agree and did not agree at all with loosening the regulatory standards and that new legislation that was passed, whatever year, 17 or 18.
So thanks very much, Rob. So I'm going to go through some of the questions from the listeners. There's about a dozen questions already supplied, so we'll have to keep the answers relatively short if we can, to try to get through as many of them as possible.
Good.
So the first question really it addresses the issue of what the questioner describes as zombie banks in the US. So the questioner raises the example of First Republic requiring extensive funding support from the Federal Reserve, from the Federal Home Loan Banks, and also from the larger banks that have replaced deposits with them. What do we do about zombie banks, and how damaging will it be if we have a number of institutions that remain in this zombie status for a more extended period of time? How do we address this?
Well, so here's what I know and what I don't know. I know there are zombie banks, and your questioner mentioned one of them. And what's the definition for the audience of a zombie? 200 billion plus in assets, $2 billion market cap. I don't need to say a lot more. And basically the loss in market cap from 30 to 2 or whatever it was, 25 to 2, goes right to their hold to maturity account and marking that to market. Now that it is a zombie, I'm sure there's a cost to the system of having it just limp along. And the only way to survive, I think, is in shrink mode. It's going to take government resources if it ever does merge. I doubt someone's going to buy it without needing some type of credit support. And so the money that might have gone to insuring, checking accounts, let's say, from the FTC account, is going to go to that instead. And there's a certain number of these big zombie accounts, zombie banks, and yes, they will require resources. And so what is my view? Probably the quicker you can deal with them and shore them up, it might be healthier for everybody, but easy for me to say. It's an agonizing decision.
Second question relates to the exit of deposits out of the banking system as a whole, with funds moving into money market funds. So how concerned should we be about this? And to what extent is this being made worse by the fact that the money funds now have access to Fed ONRRP, which they didn't have in previous cycles?
Yeah, you can blame me for that second one, because I approved that and I didn't foresee that this would be the effect. Yeah, there's a viable competitor to a bank account, and it's 100% federally insured. So of course, yeah, it's a natural suction for savers to take their money out of banks. That's a reality.
And does it matter? I mean, so of course it matters, but how concerned should we be about funds exiting from one set of financial structures, regional banks and other banks, to another set being the money market funds?
So the reality of this world is for small, mid-sized banks to fund themselves, they need business deposits and they need savers. I think you're gonna have a lot harder time in the future attracting savers, and nobody knows it better than they do. And so what's it mean? It's just gonna further atrophy the small, mid-sized banking system. And you're gonna, even if we did this deposit insurance thing I talked about for checking accounts, if there are 4,500 banks today, they're going to be some fraction of that 5-10 years from now. And this is one reason why. They're going to struggle to attract savers, and it's understandable.
So another questioner asks, we all anticipate and expect to see deposits repricing higher, but can we actually see this in the hard data yet, or is this something that'll take a little bit of time to emerge?
It'll take a little time to emerge, but I have lots of conversations with bank CEOs, and they're telling me, they're throwing out numbers. They say my cost of deposits has gone up in the last 2 months. You pick 150, 200 basis points. That's what I've heard.
So these are big, not at the margin changes.
Change the nature of their business. And again, it gets back to, we've got to prune our loan portfolio and really scrub it.
One of the questioners says, all this focus on duration mismatch and NIM, doesn't this, of course, apply on the greatest scale of all to the Fed itself, with massive negative carry on the bond holdings that it holds relative to the cost via OER and ONRRP. So I think the short answer to that is yes. The longer answer is, in what ways, if any, should we be troubled by that, Rob? What do you think? Is that a fact, but one of little consequence, or is it something that is important?
It's a fact. It means the sweep to the Treasury will be negative, not positive. In other words, the Fed will lose money now, made money for many years. But the Fed has permanent capital. The problem with banks is, deposits are not permanent capital. The Fed has permanent capital.
So next questioner asks about, beyond the credit contraction itself associated with strain on the regional banking and community banking sector, if we are looking at a world in which there is perhaps a relatively slow moving but mass extinction event, what does the future industrial organization, what does the future structure of the US banking system look like? And if it does have a lot fewer of these smaller and regional entities, how will SMEs in this country get access to the credit that they need?
So what you're likely to see, there was a trend pre-COVID going on, which you know about, and you go to a small town in Texas, Wichita Falls or someplace else, and they'd say, we used to have X number of local doctors. We used to even have a hospital. No hospital, no local doctors. We got to drive 30 miles in case X, Y, or Z happens. It's more likely that that same town will lose its local bank. And then it starts to be, if I'm a business, do I really want to locate in that town? And then it starts to be, if I'm a child growing up in that town, when I get old enough to go work on my own, do I want to stay in that town? So I think you'll see a bit of a restructuring of small, big towns in the United States, and there'll be a natural advantage to big business over small business. Scale, big business over small business. It'll be harder to start a restaurant, harder to start, or at least unless you have equity or you have great growth potential. It's just a reality. I personally think the country is far better off with a small, mid-sized banking system and having vibrant towns throughout the country. and emerging small, mid-sized business. That's the American dream. I think it's going to be more challenging.
Questioner asks about CRE and asks you to clarify, are you concerned specifically about office, which has some very specific issues post-COVID, or are you concerned about CRE in a larger sense across categories?
So the issue on CRE generally is projects look great when the loan rate is 3 or 4 or 5%. They're a lot tougher, let's face it, when it goes to 8 or 9 or 10%, and the valuation of the property declines. Now, if it's multifamily, pretty good demand, good, it helps. The problem with office, especially post-COVID, is, work in office environments, the whole world's changed. And so you pick whatever in CRE where you're worried about the demand side. And it's compounded by the fact the cost of capital is also going up. The reason people mention office so much, and I do, that's the most challenging, where people just may not be using office buildings and there's a lot of empty space. And so that's natural that you may see a lot of these write-offs happen there, but there may be projects in other sectors, depending on the town and the city and everything else, where the cost of capital being this high also stresses the project.
Another question talks about the evolution of the Fed's balance sheet. So in recent weeks, what we've seen is ongoing QT in the background, but of course also an increase in the Fed's aggregate balance sheet coming from the mobilization of emergency liquidity facilities, including the new bank term funding program. Yeah. Is that something that is appropriate, is reasonable under the circumstances? Or is it odd to have two different instruments moving the balance sheet in different directions? And yes, to what extent should we think about the increase in the balance sheet as having some of the characteristics of QE, if not literally like for like, in terms of the large scale asset purchases previously?
So if you roll the tape back to, I guess it was a year ago, you and I had the same conversation. And I said to you at the time, I'm not that worried that people are not going to be able to weather the Fed funds increases. I didn't anticipate this asset liability mismatch at the bank. But I said to you, people are going to be talking a lot more about the balance sheet runoff. That's where you're going to see risk spreads, access, credit spreads become much more problematic. Since that time, the Fed got down to whatever, the numbers better, 8.5, 8.6, it's back up almost to 9 again. I think draining liquidity from the system is going to be brutally hard. And of course, it's odd to be running off the balance sheet on the one hand at $95 billion a month. At the same time, you're a senior unsecured lender to the banking sector and you're increasing the balance sheet. This just shows me the running off of the balance sheet is going to bite much more than the Fed funds increase, because the drain of liquidity, this gets back to bank deposits. Drain of liquidity is going to show up. It just lack of funding. Risk premiums going up. Big businesses will weather it fine. Small businesses will struggle with it. I think it's going to be very hard to run down this balance sheet.
A related question.
And this is, by the way, this is why on the way up, I was one of the annoying people screaming, let's stop this damn thing at 6.25, 6.5. Let's not let it get so big, because it's like this is terrible. Roach Motel, once you get in, it's a bear to get out.
So related question says, if the Fed pauses rate increases, would it be appropriate to carry on with QT? And then as a follow-on, if at such a point the Fed judged it was appropriate to cut rates, could QT carry
on? If you're going to fight inflation, and this is a good debate, I think the Fed funds rate is a more potent tool to fight inflation. I don't know what the effect is of QT, other than I think it's very unhealthy for the Fed to have this big a balance sheet. I don't know what role that plays in the inflation fight quite as well. As you've heard me say, I really think it would be bad if the Fed keeps raising the Fed funds rate and then has to cut it. I'll be confused. If I were going to stop something, I might scrutinize the balance sheet in the context of what I just said. I don't want to stop the balance sheet runoff, but if I were going to stop something, I would not be cutting rates. Because I think that's the most potent tool we have on the inflation fight. And I'm sure the Fed has a strong view on what the role of the balance sheet is, but they ought to crystallize and debate that. But I think it would be ridiculous in many ways to cut rates and keep the balance sheet running. Then I'm kind of lost a little bit as to what the theory of the case is, to be honest with you. They'll have to explain what the theory of the case is.
Yep. So more questions coming in. We're going to have to do a lightning round now with the last few minutes remaining to us, Rob. One questioner says, interested in your idea of full deposit insurance of payroll accounts or up to a very high ceiling. But does that really solve the cost of funds issue? Isn't it likely that in the current environment where people have been woken up to the big spread between rates available in very safe money market instruments and rates available at banks, that we would continue to see some combination of deposits moving out of the system and having to be replaced with higher cost sources of funds, and separately banks having to price compete in order to keep those deposits in place?
Yeah, so I agree with the question. It addresses a part of the problem, which is, can the bank keep its payroll accounts with customers? And I think most companies, including mine, are willing to get paid a low rate on a payroll account because we're churning the money. I'm not willing to get paid a low rate on savings, though. And I think, to your point, your question's point, people are waking up to that, and that horse is in the process of leaving the barn. Doesn't solve that problem, but I think it would help on keeping your business customers in the bank. Once somebody leaves your bank to take their payroll account elsewhere, you're never going to see him again.
So, Robert, I'm going to editorialize a little bit here myself, just very quickly, but on the saver side of things, if banks' business models rely on their ability to rip off their savers and pay them returns that are far below the economy-wide interest rate, yes, shouldn't we take the view that that's not a business model we want to persist in the long run? Yes. The public interest is better served by shaking those out?
It's funny you say that. That's always been my private view has always been, I can't believe people are willing to accept it. And it's kind of hard to have a business model based on your customers being asleep.
So a question then says, questioner asks, what does a future sort of banking business model look like? And to what extent can non-bank entities, spec finance, alternative asset managers, and others step into the breach here not just in the long run, but also potentially over the next year or so as the regional banks have to pull back, even divest of some of their portfolios?
All right. So again, let's segment out. They're the top 10 or 15 banks in the country. They might as well be in a different industry. Those banks are fee generators. When they make a CNI or CRE loan, they write it and then they sell it down. It's probably not even on their balance sheet. Small, mid-sized banks, they're making those loans. And they don't generate much fees unless they happen to do payroll accounts and do cash management services. And many very small banks don't even do that. And so they're relying totally on lending. There's going to be a restructuring of this industry, no doubt. Here's the problem. I've looked hard at BDCs. I've looked at other options, and people say, that BDCs, they can step in. Well, yeah, if you want to pay 12 or 13%, maybe with an equity warrant, they're not always mezz, but they're closer to mezz. If you want a SOFR plus blank loan today, the issue will be who can do those loans, know the borrower well enough to actually make an economic loan for the lender. Now, consumer loans are different. I can look at a FICO score, push a button, fine. Business loans are different. I actually got to meet the business, probably go in there. It's expensive to write those loans. So it's not obvious to me that some wholesale non-regulated group is going to come in there and provide those loans other than a very high rate. So I don't know the answer is the point.
And perhaps they may have a role in sort of in distress, right? In picking up assets out of distressed banks. But that's not quite the same thing as providing, a substitute supply of capital.
And they're great merger lenders. Going to merge two companies, fine. Go to a BDC, might whittle down other sources of finance. But the most of the lending in this country is boring. Working capital line, maybe a term facility for some business needs. It's not great business for big banks or even for BDCs. They don't do it.
And a related question, do you have any financial stability concerns around non-banks, or do you think right now the issue actually is really around the banks themselves?
Well, okay. So if you had asked me 6-9 months ago, where am I really worried? I would have told you the sector we've got visibility on, the banking system, we'll be all over that. So that's not my worry. It's the stuff we can't see. And so much financial activity has moved into non-bank financials. That's where and this pension fund derivative issue in the UK seemed to me to be indicative of that kind of worry. So I still have the same worry about non-bank financials, and I'm sure there's going to be blowups there. I don't know that it'll be systemic. It didn't occur to me that there would be sitting under our nose, staring us in the face, this glaring issue, and we just wouldn't pick up on it until it was too late.
The questioner asks, if banks don't want to hold duration because they've taken all these mark-to-market losses, and now we're going to get potentially more push down of regs into a bigger swath of the banking system, and the Fed, meanwhile, is continuing with QT. Who's buying duration in this market?
Well, so let's just remind ourselves, just to put into, let's say we go down to $100 billion or more. Do a little quiz for people. How many banks do you think in the United States have assets of 100 billion or more? Turns out it's that big a number. It's less than 50. I think it's 35 banks. It's not a huge number. So fine, those banks, yes, they may not be able to buy duration the way they used to. And yes, I think other buyers, non-bank financial sector, others are going to have to buy treasuries. But I know this is a worry for some. I read Ray Dalio every day and his Bridgewater. People have to realize the banks have been a big buyer of mortgage-backed securities and treasuries. And in the future, for those term securities, they're unlikely to be the buyer. It's going to have to be somebody else.
So it's going to have to be the real money long onlys. It's going to have to be some alternative structures. And
then this gets to the happy topic, as the dollar is the world's reserve currency. While you see kind of in the background, China and Brazil agreeing to bilateral payments, you got to really be worried and make sure we do things to protect the dollar, if to the extent we can, as the world's reserve currency, because we've really over-relied on that with the amount of government debt, present value of unfunded entitlements. We are vulnerable. And that people say how long it might take, 20 years. Yes, but you better worry about it now if you think it could happen 20 years from now.
So that's a very rich topic, probably for another day, Rob. We're not going to be able to do justice to that today. Our hour is up. Thank you so much, Rob, for your kind thoughts and insight. Thanks to all the folks who joined and asked questions. Fantastic discussion, Rob. I will ask for your indulgence and say let's do this again before too long.
Love to. Thanks, Krishna. Always great to talk with you.
All the very best. Take care. Bye-bye.